Welcome to Vol Stars, a GammaStrike production.
You know, we haven't really ever talked about this, but that intro goes pretty hard. Gets me every time still. All right, well, this week is me, Gherk, and Ron, because Dork is off getting hitched.
Maybe.
I suppose he's in a pool somewhere. I don't know. I haven't heard from him. He didn't invite. Well, I guess he invited me like a week ago, but I'm not flying out to Reno in a week's notice. So anyway, Dork might be gone for good. We don't actually know.
I hope not. He's way better.
That was his vow. His vow was no more episodes of All Stars.
No
on
more
Sundays.
Time with the boys. Yeah,
Yeah.
it is a
Maybe.
premium time slot for a lot of people. But anyway, all right. So seems like we're sort of in purgatory where a lot happens and nothing happens all over again. I guess we'll start with the S&P 500 hit a new all-time high over 7,700. Did we tap 78? We got pretty damn close.
We got 77.60, I think.
Well, now I gotta look.
So, yeah, I think the new all-time high is 77.93.
Yeah, there you go.
67. So we did get really close.
Wow.
Yeah, that was on August 5th, Wednesday. So what's going on there? I have my theories supported by data, but I'm interested to hear what you guys think was happening there.
I mean, we got a little bit of a gamma squeeze. Well, delta, I guess more delta, right? We had a bunch of bot puts on the chain when the peace deal was announced, before everyone had time to realize that it was actually a deal between Oman and Iran, and had nothing to do with the fucking U.S. whatsoever. But we squeezed off like some of the bot puts on the chain in the initial leg, which was like, Monday. And then we Vegas squeezed. We Vegas squeezed all the way up, and then that shit collapsed pretty quick. And we ended the week like pretty flat on the initial like Vegas squeeze, that the gap, like morning gap up. But we're still in an environment where like dealer books are concave, and like it's going to be hard to like break the downside trend.
Yeah. Unfortunately, you pretty much stole my answer, so
Sorry.
I agree. No, you're good.
That's kind of the problem, is we're both working with the same data.
Yeah, I thought it was pretty obvious, especially on Wednesday when it was spot up, vol up pretty hard.
Yeah.
Crazy week though. I mean, it just going like straight up, and
we like slammed through Gamma Max, which was wild.
Yeah.
And then obviously mean reverted right back under it like the next day, but that one day, Tuesday, I guess it was, we held. That was wild.
Yeah, what was it like? Monday was it up 1%, then Tuesday up 1.5% or something like that?
Yeah.
I mean, it was a crazy week. But I don't know. Market's going to do what market wants to do.
Yeah, I think, it's pretty clear when you see, everything kind of going flat like it was before it squeezed. Like, that was just everybody piling into short ball. And then now it's getting blown out, of course, to the top side. The best part is that Leopold got liquidated.
Yeah.
Right before everything shot straight up.
Yeah, everything
which is
fully
great.
recovered.
because apparently he's been given another, I think, $450 million or something like that. So he's gonna, I guess, do the same thing again. I don't know. I guess if people were gonna keep guaranteeing me $500 million, I'd try to martingale highly leveraged memes too. He wasn't very situationally aware though,
No.
which I find ironic. Well,
Yeah. Speaking
what
of
do we
memes,
think?
though, what did you guys think of SpaceX this week?
It's weird that it stayed up after the
it?
unlock. Well, it went up into the unlock like through the first day or two of the unlock.
Yeah.
Yeah.
I mean, the
I
earnings
mean,
went about what I expected. Total dog shit, hounded by massive spending in AI data centers because who needs more of the, we need an infinite supply of intelligence, I guess, is what everybody's saying.
Infinite
I
TAM,
mean,
though.
given where like SpaceX closed pre-earnings, which was like, you know, so like 114 or something, which was below the IPO price. I don't know why the expectation would ever have been that like they're going to sell off at a lower price than the IPO price. Like just because shares are opened up doesn't mean they're gonna just dump them.
Yeah.
So that was I guess I guess that part of it was like kind of weird. Like I don't know why that was an expectation that anyone had. But it definitely was. It was definitely what people were expecting or thinking. And then obviously now, we're probably seeing those same shorts just get squeezed off.
Yeah, I think it's an asymmetry thing, right? When you have this share unlock, you imagine worst case everybody sells right away, best case everybody holds, right? There's no everybody that's already holding all this equity buys more, right?
Yeah.
So there's this huge asymmetry skewed to the downside and everybody wants to bet on that. But yeah, I guess it didn't come to fruition and then everybody was clearly long puts, especially those who also, I have to imagine too, a lot of people who are holding, especially who bought into the IPO, want to hedge by buying puts. So there was probably a lot of delta on the chain that got smushed from the vol crush and then, caused it to pop.
Huh. Yeah.
So what do we think is going to happen going forward? Because I was looking at the macro page on GammaStrike the other day being last night, and just looking at like total contract value, and it seems like we are stabilizing at a higher step and even more aggressive. So, there's usually a pretty big run. There's like a few months of flat and then a big run, and then there's a correction to more flat, and then an even bigger run to a higher high, and then a correction, and then a flat. And it seems like we had our big pump through the summer up to like 1.5 trillion in total contract value, and then it big OPEX expiration, and then it kind of flattened out. But it seems like it's flattening out around like 1.3 trillion, which is much higher than the last flat line of like 900 billion. I mean, that's pretty massive. It's like 50% increase in contract values over the course of 9 months. It's pretty large. And this has kind of been the trend since, late 2023.
Yeah.
So, I see that and see, well, if people are going to continue to lever in, is this actually just a self-reinforcing cycle that will continue to get much, much worse? or is it or are people going to chill out, or are they gonna keep cruising at a huge acceleration? Because 50% every 9 months doesn't seem like it should be sustainable. I mean, $1.3 trillion is like 3% of the entire market. That's massive for options.
Yeah, it's quite large.
Trouble though is like if it is working and it's continuing to work, then what's to stop it?
Well, the challenge, what stops it is Leopold Aschenbrenner getting mogged by Kenneth Cordell Griffin, bringing the bedpost from the top rope, and then
That
immediately
was
rocketing
that was
everything after liquidating him for pennies,
yeah,
which
that
is,
was
it was a textbook assassination.
yes.
He got picked off hard, which is, as much as I have mixed feelings about Kenneth, it was a beautiful headshot. And I
I
guess
don't.
it wasn't a
I
headshot because he's still kicking. He's given more cash to do it again. So I guess Kitty's gonna get more money out of him.
That's a
What were you
distinct possibility.
What were you saying about Kenneth?
I mean, I think what like obviously, with GME and everything, there's a long history there, but he is an impressive man. He has accomplished quite a lot. And sure, he might be evil, but in a society that rewards just raw capitalism, damn is he good.
Yeah. I mean, he's a survivor. I feel like all the folks, it's like if there's somebody that retires from finance in their old age, like if nothing else, they survived. They were fighters, right?
Yep.
That is not a field for old people. There's a
No.
lot of it's a lot of casualties in that field. Like
Yeah.
Leopold, not going to be an old man in finance. I'm going to go ahead and make that prediction right now.
Although
Maybe. I
sometimes
mean,
it's the ones who learn the lessons the youngest who survive the longest.
maybe. Yeah, but then there's like also people like Kathy Wood. Like what's she's still kicking. And
I don't know how she still has money to invest in things,
I
but
don't know. She's selling her losses as tax write-offs to people, I guess, as her primary business right now.
yeah. Oh,
It's the long game.
has been for some time.
Well,
I just feel like there's got to be more to the story of Kathy Wood. Like there's got to be like she like wronged somebody, you know, and they've just been going after her the whole time. That's all I
I don't
can
know.
think of.
I feel like she's just got like Masayoshi Son syndrome where she's just late to everything and overholds. Like, doesn't she still own Zoom?
Maybe.
Like, who still owns Zoom? Like I mean, sure, it's common and people use it and it's not going anywhere, but obviously there was a lot of back and forth during the pandemic about, it's like the Simpsons meme where the disco chart,
Mm.
disco's going up and up and up forever. And it's like, oh, the pandemic, everything's going digital. The real world is going to become obsolete and everything's going to be done online. We're all going to have to hook our fingers and our dicks into little devices that shock us and tell us how to feel on the internet.
It does kind of make you wonder how much did the mouse shakers actually make as far as like a business, or what was the total business on that?
What made more money, the mouse shakers or the hot dog swipers during the whole online dating craze? You see those as videos where like people just put like a
Yeah,
hot dog on a
everything.
motor and
Yeah.
just spin the hot dog because the hot dog can touch the capacitors on your touch screen and get it to respond. It's literal meat spin.
Interesting.
If you spin it long enough, a woman will notice and go out with you.
Oh, curious. So that's like is that the end goal?
Yeah, you
I don't
open
know.
yourself to everybody, I guess, by doing that.
I'm one of those weirdos that actually I've never used online dating apps.
Me either.
I'm old enough to remember when online dating apps were weird. Now I'm the weirdo for I've
No,
never
they're
used
still
one.
weird. Nothing's changed.
They seem awful. Seems like a rat race. Seems like hell. I'll be honest. It doesn't seem pleasant.
It's not.
Yeah.
But yeah, we're probably not the three people to weigh in. I don't know.
No.
So anyway, back to the market. Kathy Wood underperforming. Leopold getting wiped out. South Korea getting wiped out. I mean,
Repeatedly.
they're
Yeah.
I mean, they're starting to push like huge. They're at the point where they're now doing regulations. So they're the point of the cycle where they're past euphoria and past despair, like a little like kind of getting through despair and into like what do we do to make sure this doesn't happen again, right? And then the rest of the cycle is then dismantling all of those regulations that would have prevented it from happening again, so that it can happen again, which is
Yeah.
kind of where we're at. But yeah, so what's next for us? Are we gonna get more uppies, more sideways, some downs? What do you think?
I'll weigh in first if that's okay. It sounds
Sure.
like you got some stuff going on in your background, JFresh.
My kids are so loud.
They're just enthusiastic, we'll say. There we go. Um, I feel like we're gonna probably see a little bit of a stabilization, I think, for maybe the next few weeks, and then kind of maybe try to retest, start going back up. But I don't know. I feel like so much of it really is kind of off of the narrative that things are improving in the Middle East, and whether that's a reality or not, I don't know if that's going to really hold, but we'll see. But what are your thoughts, Gurk?
I mean, I think the Middle East and pricing around oil has a lot to do with things, but I would say like it really seems that things are more structural at this point, and like the changes in yields at the top end of the curve aren't really moving with yeah, I mean they're really not moving with oil price very much. I mean the like the change in the 10-year relative to like the 2-year is so insignificant. So like we're pricing up and down risk at the front end, but like the long term risk is it's gotten a hold, and I don't think there's anything that anyone can do to shake it. And I think that might be the thing that everyone's like missing is like obviously all of us have waited so long for the market to be like, oh man, everything's mispriced, and now that we're finally seeing them recognize that in a more durable way, I don't think that's gonna go anywhere. I think that's gonna be more of like a feature now. And so, sure, we can get these rallies, and we can break to the upside, but I don't think I don't I think like the idea of like the market just continuously rallying, and getting other like massive bull legs, is probably like that era is probably over, at least for this cycle. And I think we're probably closer to like major policy intervention right now than we are to like another year-long bull market. So I would say this local move up, which was very mechanical and largely backed with like gamma, and as we said, like Vega, like this is probably going to collapse. It's already started to a little bit. But then I would say that like we probably see even more of that, as we move into like as we move into like the latter part of the year into September. Like we've got physical supply issues in oil right now that aren't going anywhere. So we already know that oil is going to pressure inflation up later, regardless of what we do. We've got refiners running at max capacity. We've got, you know, six transits in the Strait a day versus 140 that we used to get. You know, and we've got like Iran issued like well, we'll get into that in a minute, but like, you know, obviously like there's no fucking deal between the US and Iran at all. And I think maybe Trump was hoping this like Iran Oman thing would give him a clean exit, but it doesn't. It doesn't unless he's willing to like just sacrifice the future of US hegemony completely in order to attain his own ends, which I wouldn't be surprised about. I could see Trump doing that, but I mean, obviously, that's not going to be, you know, economically adjacent to his goals. Um, so yeah, I think we're just still trapped. Like the situation is relatively unchanged, and we rallied on bullshit. So we usually, if you rally on bullshit, you usually pull back on it too, to a degree. And I also think like a lot of the narrative that drove this, right? Like the even dip buying prior to the bounce was like, you know, Microsoft was going to kill it, or Microsoft is killing it on AI. All these hyperscalers are doing great, and then that's proven to be not really very true. Yeah, I think it collapses. This is all like if you look at the options chain, none of it looks durable. It looks very short dated, like what I like to call spurgy price action, where like everyone just rushes in at the front end and like nobody's buying any duration on anything. So you got like the big spike in gamma, which was insane, by the way. We went from like negative gamma to like right to 100 million, like 100 billion, which is like near all-time highs for the SPXW chain. Um, and that, you know, obviously like once you hit the peak of that gamma, it starts to collapse really, really quickly because there's so much profit to take in the money, that all the supportive structure that would hold up a more durable rally just kind of gets rugged out from underneath it. So those are
Yeah,
my thoughts.
you also get far enough up and it just starts weighing down more movement.
Yeah, yeah. And like even like we moved up so hard, even the charm effect from all the in the money calls became like instantly irrelevant because they're too deep in the money. So
Mhm.
they're already priced at 1 delta. So there's no
Yeah.
like bleed up to like
Yeah.
save things. And usually when you run into a scenario like this, you get over like a big wall of positioning and then you're just over it. And so like the trickle from charm helps stabilize things. But we blew through it so fucking hard that it's like 1% in the money. And so like, you know, that there's no effect from charm into like August OPEX. And so far since the Wednesday morning high, you know, we've seen Delta and Gamma both just dump off at the top of this rally. And durable rallies don't do that. They hold steady. Gamma holds up, Delta holds up, nobody closes, right? More people buy in at the new high. People don't take profits at the high. You know, they want more money. More
Yeah,
premium.
I noticed a fair amount of people trying to call the new top, coming in with more sold calls. I always get a little skittish when I see all the sold calls because that's part of the reason why we squeeze up is because nobody usually when people are selling calls, they're trying to cash flow something that they don't want to sell.
Yeah.
And the market doesn't go down unless you sell. And you know, if nobody sells and you're selling all these calls, the person who's going to get run over every single time are the call sellers
Yeah.
because no otherwise the money has to literally come out of thin air, right? Somebody has to lose without selling and they're not going to, so you're going to. You made the wrong bet. And the only way to make money in that situation is to actually sell something. But nobody wants to do that because we're still in like everybody's still more afraid of the market going up than going down.
I mean, to throw a wrench though at things, we're coming up on an election cycle, right? Do you really think we're going to see any kind of meaningful correction or pullback or would it be just really temporary before then?
I think we're very likely to see that. And to a point, I do want to say one thing. While I do largely agree with you that anytime people start selling calls, there's a risk they squeeze out. We moved up like 6.5% in like 3 days. And I think at that point you end up with a market where call pricing is so oversaturated that the enormity of the call selling is just more than the buyers can break. Like you need repricing before things can push back up again, because like buying a call anywhere near here is absurd already. So I mean, you really need like, and all the incentive is to the sell side.
Yeah, no, I don't disagree. I'm just saying.
Don't get me wrong. Like a week from now, if there's another like catalyst to drive upside, I could see all the calls getting squeezed out. But right now, they're very overpriced.
So I have another piece of data that I would like to go through in the context of where the market is headed. But before I do that, I do want to pick your brain about an interesting trend that I've noticed just in the last few weeks of earnings season. It is that there seems to be a growing number of especially tech or tech adjacent companies that are meeting and or exceeding earnings in either all of the metrics or all but one or two of the metrics, and getting punished regardless. Like it's
Yes.
sometimes quite dramatically. And I wanted to hear your thoughts on that. And
Now,
no,
I
I have
know-
not been reading. The only thing that I read.
I was gonna say, I know you refuse to read Pickles Picks, but have you been watching Market on Close?
Would you be sad if I said I have?
Yeah, I would
I'm
be.
sorry. I watched a few
okay.
of them. They're great. Yes, it's been a few rough. It's been a busy few weeks.
All right.
Okay.
Well, so
Quick aside, I've been very busy with every spare minute that I have trying to beat the compiler in Marathon, which if any of the like 4,000 people that still play that game, because apparently it's dying and it's because it's too hard and punishing, but very hard to do. Finally
no
beat
wonder
it
you
this
like
morning.
High skill games. High skill games are always punishing to growth.
Finally beat it this morning.
Yeah.
Ooh.
Yeah.
Congrats.
Yeah, it's you go as a trio, and like I just random fill, and we had one guy just clearly knew what he was doing. I knew what I was doing, and then we had this one other guy who just had no idea what was going on, and we just dragged this poor guy all the way to like the end game.
Classic
content.
League of Legends scenario.
He, to his credit, he did exactly what we needed him to do. He was a great sponge, and at the times we needed him to be a sponge.
Perfect.
He went down gracefully, got right back up. Anyway,
well, for our one viewer, Market on Close is like a thing I've been doing to try to substitute for the fact that I hate being on stream for 8 hours a day. But also just because like so much of the market has been revolving around like the geopolitical and macro conditions lately that I need time to cover them, and during the trading session isn't a great time to do it. And the changes are so quick every day that it's a good thing to have like a place where we can kind of discuss that each day after close. But basically, I've been covering a lot of this earnings season, and I really covered it well on the other night. I think it was like episode 56 or something like that. But basically, we're in a scenario where these companies are priced not only for perfection in earnings, right? They're not just priced to meet, they're no longer priced to just meet analyst expectations. They're priced for acceleration, right? And this is a really important caveat, is that they're already priced to beat, but they're priced to keep beating by more. And what they're failing to do is meet that, right? Because, and this is especially obvious in semis where the earnings are phenomenal. Like we were talking beating analysts' expectations by 20, 30%, and then the stocks are selling off 9% in the overnight. And that's because it's a very, you run into this very like pick two scenario where you either, right, so you have demand, you have high prices, and you have supply. And so what the market really wants to see from the way these companies are priced is, in order to see acceleration, demand has to be maintained, but also the margins have to be maintained. And so the backlog of orders, the margins, and that needs to continue. But in order to satisfy the demands of their customers, they need to increase supply. And if they don't increase supply, then their backlogs are going to reduce. And so they can only really pick like two points that they can address, and then the other one has to fail. So either you have to narrow margins by increasing supply, or you need to keep supply tight, but you're going to reduce your backlog and slow the acceleration in your growth. And in every instance, we see one or the other happening, right? They're either like, oh, we're going to commit, 30 billion to CapEx, and we're going to increase our production of, whatever our product is. But but that means that their margins are going to come down, and they're, and then so they're not going to be able to meet that metric. And in every scenario, we see that they can't satisfy all three conditions. It's impossible. And so we see them selling off in order to reprice, because they can no longer, one of those things cannot be priced in anymore. Like either margin expansion can't be priced in, or revenue growth can't be priced in, or demand can't be priced in. And so, even if they meet on two, they're going to lose on the third. And we've seen that with every big tech earnings, even the software companies to a degree, and especially the entirety of the semi sector. I mean, some of these companies are up like 300 to like 1,800% in a year. I mean, like the growth that's priced in is fucking insane. And everyone knows, like, if Micron opens up like 3 more production lines, their margins are going to shrink. Like it's inevitable. So no matter how much great forward guidance or how much the revenue beats by, it's the future pricing that can't be attained. It's simply impossible.
Well, there's another kind of unexpected or unanticipated consequence of basically the memory mafia trying to squeeze the people who've been squeezing them, is that people like Apple and others are starting to go to Chinese manufacturers who are more than happy to step in to that void and say, hey, oh, you want cheap shit? China knows how to make cheap shit. And they're starting to validate some of those product lines from China, which is really scary, because that's generally the only actual moat you have, is your reputation and your
it's scarcity, right? It's like Bitcoin.
Well, it's just
it's
like
imagined scarcity keeps like HBM memory prices elevated.
It's hard to quantify, and it's nearly impossible to put in a RFP or any requests for something, but there is a huge premium that everybody is actually very willing to pay to know exactly what you're getting every tip, for dependability and for reputation, right? I don't have to worry about bullshit, because I know that if this person has an issue, they're going to eat it and they're going to do whatever it takes to make sure that I don't feel the effect of that. That's worth so much, right? And so a huge barrier to going to China is it going to be as good as what I had before? Right? I don't necessarily want it to be cheaper. I want it to be at least as good as what I already have. And can they deliver that?
Isn't
right?
the actual barrier like the fact that trade with all of these companies is still massively restricted by the State Department? Like all of these manufacturers are like directly part of like Chinese army, like Chinese military infrastructure.
Well, yeah, it was like back in the
so
whole
like,
Huawei, no 5G, we can't use Huawei's 5G stuff in our country because it could be a backdoor to the CCP. Yeah, same stuff,
I
but
think
it's Apple.
I think the legislative hurdle is still like even if it's Apple, it's still bureaucratic red tape they have to blow through.
Who in Washington is going to run to Silicon Valley and arrest Tim Apple?
I thought he quit.
I think he's still there, but he's in the process of quitting.
Yeah, I think he's working on his next
exit strategy.
Yeah. But we have an important thing we need to address too. Gherk, you didn't tell people how do we get to see Market on Close for those that don't know that are listening.
Oh, it's on my YouTube channel, Pi-Fi, every night after market close at an undetermined and slightly random time. Sometime between 6 p.m. and 9:30 p.m. weekdays.
I'll also post a link in the notes though. So sorry
I
for the
see what
shameless
you're
plug.
doing. You are, yeah, well, please do, because I will watch that episode. I need to go back and watch it if it's basically answering the question that I just asked about earnings. And
I mean,
I just kind of thought,
I just did a better job of it then. I was less on the spot.
okay.
I had planned the discussion versus you just hitting me with it out of the blue. But no, I mean, it's same general gist though.
How is it out of the blue? We're talking about where's the S&P going to go?
Yeah, but earnings have very little to do with where it is.
Yeah, true. That's very true. So the data that I promised that I wanted to talk about was really it's a story of leverage, right? And what determines how much leverage somebody has? Well, the denominator is cash. And so a big question is where's all the cash coming from to make sure that we're not just over leveraging? Because we're already at record breaking levels of leverage everywhere you look. We're levered to the actual tits. And so the question becomes, if we're going to continue marching higher, where is the denominator growth coming from? And so for that, the mile high view is just M2 growth. And right now M2 is growing at a healthy, 5% year over year. So we're talking like $1 trillion plus of money every year. And if you want a more detailed look into how that money is growing, right? For people who don't know, money is debt. Debt is credit. Who makes credit? Banks make credit. And so you go and look at how are credit and loans growing at the banks. And you can find that from Federal Reserve data, the H8 tables, Harry.8. And I love to look at these. It gives you a 1 year look back. I think on Fred, you can go back even farther and look. But I like to look at these because, they have a bank credit, which is kind of tells you how much they own in. So these are like the assets. So for them, it's for you, it's a loan, it's a deficit. For them, that's an asset they're holding. But it tells you like how many treasuries they're holding, how many mortgage-backed securities they're holding. But what I really like to look at is loans and leases and bank credit, because that kind of tells you they break it down into all the different subcategories, and that tells you where all the money is being created. And right now, if you compare, so they have data through 2026 of June, and then They have weekly data going through July, but the July data is not finalized yet. So just looking at from June 2026 back to June 2025, loans and leases and bank credit grew from 12.9 trillion to almost 13.9 trillion, right? So that's where the money is coming from. It's coming from largely their loans. And we've talked about this a couple times on this show, especially when bank earnings roll around. We're always looking at the SLR, supplementary leverage ratio, which is essentially what are their if there's a run on the bank, how able are they to handle that run on the bank? And you basically can't be more levered than something like you can't have less than like 5% of your assets be non-cash. So you basically need to hold at least 5% cash. And all of the banks are already like pushing up against that. And so whenever they're expanding credit, you're always thinking, okay, well, where's the cash coming from to keep those ratios in line? Well, right now it's coming from the Fed, although the Fed's kind of trickling off, and we'll see how Kevin Warsh is going to continue to evolve the exchange of cash for bonds, because bonds are not included in the supplementary leverage ratio, which is the big sticking point. Anyway, I digress. So if we go, so they've made $1 trillion in loans and credit. And so you look where it's going. So commercial and industrial loans has risen by about $200 billion. So 20% of that growth is in commercial and industrial. You have real estate loans, which includes both residential and commercial. So the residential side has grown by like $30 billion. Basically nothing. Like 3% of all the money growth has come from residential real estate loans. What's interesting is that maybe half of that has been in home equity lines of credit. So really it's like $15-20 billion in new mortgages. It's like nothing. It's pathetic.
Really bad.
If you go to commercial real estate loans, that's about 100 billion. Okay. So now you've got, of that 1 trillion, you've got 300 billion going to commercial and industrial, with 100 billion of that as real estate. Then we go to consumer loans, and consumer loans, about 70 billion. So not nothing, but a lot of that's, just credit cards, a little bit of that. It's actually about 30% of that is automobiles. And then it's just credit cards. So credit cards and automobiles is consumer loans. And then you come to my favorite category, which we've talked about multiple times also on the show: all other loans and leases. Specifically, primarily it goes to this category called loans to non-depository financial institutions. What is a non-depository financial institution? We're talking about private credit, private equity, all these folks who do not take in cash deposits from people. They are not a bank, but they still engage in a lot of financial activity. They still issue credit, right? So they are also creators of money. And if you look at it, it went from 1.6 trillion to 2 trillion. So $400 billion of that 1 trillion. So 40%. Then you also have another category: all loans not elsewhere classified. We love those things. Just the trash can. Everything else, all the garbage that doesn't have its own category, went up $140 billion. So all other loans and leases altogether, and it's basically kind of the same shit, right? It's all just going to non-bank credit issuers who are not regulated, right? The whole point is that it's not regulated, so you don't have transparency into where the money is going, and you just have to trust that the banks are making good decisions. Which, okay. But anyway, so the all other loans and leases category altogether went up. If I'm doing the math correctly in my head, just the estimate, about $500 billion, a little over 500 billion, so over half of all the money that's been created over the last year has basically gone to private credit. And most of that has gone to junk or near junk bonds in AI, right? And so what is growing money right now? Investment in AI. What is everybody dumping all that money that's being grown into? More AI. So it's just AI creating money to then put right back into more AI. And it's just sort of this, right now it's a very virtuous cycle, but it's going to end up eventually becoming a very ruinous cycle when that process stops, right? Because it's all about momentum. You need the investment in AI to create the money to invest more in AI. And if you stop doing that, projects start to go unfinished, bets start to unwind and they have to be liquidated, right? And so you need that momentum, that continuous momentum to prevent liquidation. And so you look at, the earnings of the S&P 500 and we talked a lot about how, hey, there's companies that are beating earnings, but they're dropping 9% after hours anyway. And you think, what dropping? The market's going straight up. What's dropping? Well, the things that are going straight up are mostly the mega caps, the hyperscalers, the people who still have, some semblance of a balance sheet. And what and also, if you look at the earnings, right, the net earnings of the S&P 500, they're going through the roof. And the primary reason they're going through the roof are weird gimmicks like Google and Amazon, and those folks are marking their Anthropic and OpenAI holdings to market.
Yeah.
And calling that earnings, while at the same time calling all of their operational expenses to maintain the infrastructure as an investment, right? So it doesn't show up on, their expenses. And so you have a situation where they're not including their costs and they're including money that they haven't earned, that doesn't exist. Of course everything's going to look great. And this can continue so long as nothing breaks, nothing slows down. But the second it slows down, the earnings collapse, the credit collapses, the money collapses, the leverage collapses. And so that is my primary concern when I'm looking at this market, is that yes, it is continuing to go up and it will probably continue to go up so long as credit continues to be issued to fund all of this AI stuff. But it's circular, right? And so that's kind of where I'm at, where I as long as people are making,
I see one speed bump already.
What's that?
Front end funding, like the short term cash funding, is getting tight again. And balance, like, so your H8, I'll raise you at H41. If we look at
shit.
Oh yeah, I know. If
Your
we look
number's
at,
bigger than mine. I concede.
I just have an extra decimal place, actually. So it's it's not. It's 3.9 smaller. But if we look at like how much the Treasury is pulling out of banking reserves in an era where Warsh is trying to reduce the cushion from the Fed from on RRP. We're starting to see, like, well, as we've talked about, the Fed has pulled back its bill buying. It was at 40 billion at the start of the year rollover. Now it's at 10. It's drifting even lower than that slowly. And he's trying to, reduce the Fed balance sheet. And in doing that, he pressures the primes to spend reserves to buy their fair share of the Treasury auctions. But like last, on OPEC, so I guess not last week, but or end of month, sorry, the week before last. We ran into a 234 billion dollars worth of gross treasury settlement. Now, only like 40 billion of that actually hit reserves, but on August 17th, we've got another 125 billion, I believe. And that is also like 93% mature debt, so rollover. But it's going to be another 9 billion out of reserves. And what's interesting about this is, like, for the first time in a long time, SOFR tightened up into the reconstitution and like window dressing period at the end of the month. Went neck and neck with IOR, but it didn't fall back. Now, generally speaking, after the start of the new month, SOFR loosens up a bunch, and your SOFR rate dives, and some of that's like SOMA participation dependent, but not all of it. And this time it's staying tight, and when the front end funding stays that tight, like right on neck and neck with IORB, especially when the EFFR is lower, EFFR is at like 3.62, SOFR's at like 3.65, IORB's at 3.65. Then, like, without any cushion there, you start to get front end funding or short-term financing that starts to sneak up. And as it moves more towards like intraday repo facility rates, which are at like 3.75, the desire to continue funding through those channels diminishes really, really fast. And it starts to become more beneficial to get your short-term cash from things like equities, like same as cash, or equities, right? And so we're already seeing a lot of selling in the bond market, and this is probably going to drive more of that, which pushes yields at the top end higher, and it also drives a lot of equity selling, and this disrupts a private credit market that already has a lot of short-term liquidity issues, right? So, these non-depository institutions rely on the depository institutions they're associated with and the primes they're associated with in order to manage short-term funding. And as those spreads widen, it becomes more and more difficult to have anybody manage your short-term financing. And without that, companies like, Anthropic can't pay their employees every week. They can't finance their vendor costs month over month. And they already have a substantial amount of liquidity problems in private credit. And this creates even more of them because they can't turn to the banks and the people they borrow from to shore up those short-term liquidity problems. And this can have greater fallout. Obviously, if SOFR keeps moving up above IORB, you run into situations where, like, nobody can fund their short-term financing and payrolls start to fall apart and the dollar breaks and money markets crash and all of that. But that's more extreme. Right now, just a little bit of pressure, I think, is more than enough to cause issues in private credit and create more demand as those worries mount and that short-term financing becomes more difficult. More and more people invested in private credit are going to want their money out. And this is something, obviously the private credit's been dealing with a lot over the last 2 quarters, is that they've put caps on how much you're allowed to withdraw every quarter on many of them, and that was done in response to lots of people trying to withdraw their money. And then you put a cap on it, and then more people want their money out, and so you start getting everybody meeting the cap. Right now, it's no longer like 1 or 2 investors who want to pull 20% out. It's everybody wants to pull out their 5, and they want to pull it out every quarter, no matter what. And so you get by creating the cap, you create demand that didn't exist there privately to remove money. And as more and more money gets drawn out of the system, these private credit institutions become more and more unstable. They're unable to provide liquidity at the long end for the companies that they are providing financing for, and this creates kind of like a lot of turmoil. And so I think just that little bit of friction in front end financing is going to boil over into a lot of friction in the long term financing.
Yeah, it's interesting that you mention selling of equities, because one of the things that I was looking at was cash assets over time, and
Mm.
those have gone from about 3.3-ish trillion down to just over 3 trillion.
After how long of just constantly rising?
Cash?
Yeah. Well,
Oh,
cash
I just
invested.
looking. Yeah, so this is 2025 to 2026 June. So that's dropped about $250 billion or so, a little over. And then other assets, including trading assets, has, of course, over that same period of time risen by almost 250 billion. And so, yeah, one way they can shore up their balance sheet is to try to sell assets at the top, but they're the Eggman, right?
Yeah.
So kind of interesting
I
how
mean, I
that's going to
think
go.
like
But
so much of this goes into the retail sentiment as well, with what's been going on, like for instance in South Korea, and also just in general for the average retail investor at this point. Where else are you going to park your money besides equities? It's becoming kind of the de facto where you're going to put money. We know that housing, we know that even automobiles and stuff. I mean, what are the other investment vehicles? And especially when it seems like it's a no-brainer at this point. So I do think there is maybe a little bit of a, what's it called, a shell game kind of going on, where sure, private equity is trying to get out, but there is a, hey, look at this retail. It's a great investment. And they maybe don't care about some of the fundamentals if everything just
No,
keeps
they
going up.
don't, but they've already done like an excessive amount of that. I mean, JFresh's little favorite chart where he shows how much every household has invested in the market. I mean, it's everyone's like max long already. So all
Yeah.
the 401ks, all of the pensions, all of the individual retail investors, fucked. Yeah, they're fucking, they're balls deep in this shit, and there's no pulling out. Right? They're
No.
gonna they're going to have that baby, and it's gonna be a dumb baby.
all right, and with that, that's the episode, I think. No. Okay, so I think we've probably gabbed enough on S&P. We just don't generally talk shop on the mechanics of the market and some of the inner workings that often. So I wanted to really ruminate and marinate on that. But now we go to our favorite topic that we talk about every fucking week that everybody said was going to be over by April. Iran and oil. Yay.
Oh,
What's going
again,
on
how exciting.
there?
Well, I kind of covered a little bit of this. Basically, the U.S. representatives, let's call them that. Let's not just say it's, Jared Kushner running around to different parts of the Middle East. Let's say U.S. representatives have been, touting this idea that there is a deal. There is a deal on the table to reopen the Strait of Hormuz. The deal on question is a deal between Iran and Oman on how they're going to divide up the spoils of the war that they've declared officially that they've already won. And I mean, in essence, they have. I had an interesting post on my Twitter this week, but Trump lost his shit when everyone started realizing that the reason we were backing off from the war was we depleted all of our missiles. And he said that he was going to find the leakers, and he was going to punish them to the fullest extent of the law for how dare they say these things. Meanwhile,
I think
if
he
you
was talking about his colostomy bag leaking.
that
That's
might
the
be true,
leaker
but
he was trying to find.
weirdly, if you look just a couple weeks earlier at the Senate budget committee hearing for the Pentagon, you see Pete Hegseth and General Kane's chicken fingers up there on stage in front of the senators saying, "Hey, we're going to have critical shortfalls in our missiles very rapidly if you don't give us $1.5 trillion." And they didn't get their $1.5 trillion, and so and then 2 weeks after that, they're like, "Hey, we have a critical shortfall in missiles," and Trump's like, "How dare anybody say that this is happening?" Which was weird. It was a weird, but anyway, obviously Trump backed way off from his attacks on Iran, of which he had definitely planned really big, like the greatest attacks anybody's ever seen. People in Iran came crying to him and said, "Please, Trump, can you stop attacking our country? We just want to win like you and the rest of America." And apparently those people got to him before he fired any of his non-existent missiles at them. And he decided to call off the whole thing, and the market rallied and everything was great. Turns out though that the deal being made is in fact between Oman and Iran. And part of the deal is not only fees on cargo transit of somewhere between 3 and 7% of the total value of the cargo denominated in whatever fucking currency Iran wants, but also no passage in the Strait of Hormuz for Israel or the U.S. And then follow that up and really just double down. Iran released like a 9-point list of things that they wanted, including $300 billion, access to oil markets, complete sovereignty over the Strait of Hormuz, their right to nuclearization, blah, 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 blah. Basically everything completely untenable for the U.S. to accept in any possible way. And they published that as well. But in good news, they did agree to not attack Saudi Arabia. Yeah. But now the Houthis are doing that. They've been doing it all day, actually.
I'm so looking forward to Netflix eventually putting this into a special documentary.
Well, I mean, it's just really simple. And we said it last week. Trump stuck his dick in a bear trap. And he doesn't, it's not a big dick. He doesn't have a lot of leverage to move that trap around, so it's, imagine, even if you don't have a dick, listener, imagine just any part of your body stuck in a bear trap, heavier than you can lift, and then trying to get out of that.
Wait, are we going to become a jelking podcast?
No, I don't think so.
Let's
Also,
not.
Well, I'm just throwing it out there.
Bear trap really disincentivizes any net
Yeah,
gain,
I mean,
net gain from this experience.
Breaking the skin kind of ruins it.
Yeah,
yes.
More pain than more gain.
No. This is just all pain, and it's largely self-inflicted on the U.S. by its leadership, but it is just pain until Iran says no more pain. And it's important. I mean, Iran has a firm handle on Trump's political trajectory. Americans hate high oil prices. Iran's going to ensure that we fucking have them. And we're just going to have to live with that until they get to negotiate with someone else.
Also, I'd like to use this opportunity to point out that we inadvertently did gain another listener, so now it's officially listeners. My 13-year-old daughter found my podcast and listened to it.
No.
And she was texting me. She was on vacation she was seeing cousins, and she texted me about it, and she said, I found your podcast. I listened to the latest episode. I said, how dare you? And she said, well, you're not as much of a gooner as Dork or Ron.
Oh, nice.
By the way, love you, JFresh. And I said, there's no way what we are talking about is interesting to a 13-year-old. And she said, I'm proud you don't want to bomb Iran. Also, why are you talking about Donald Trump sticking his penis in a bear trap?
Well, there's a good reason. I mean,
And I replied with, it's a metaphor.
Oh, yeah, okay.
Yeah.
Was
So
that
you
enough
taught
of an
you
answer?
taught my 13-year-old the metaphor of sticking your penis in a bear trap.
She knows.
Now she knows. And now she can tell all of her friends and teachers at school.
Yeah, this is how you get the word out.
All Stars, an educational production.
You're on.
Okay. So I just have to say, for people who don't really realize it, like us running out of missiles is probably the worst thing we could do as a military superpower. Because most of the super part of the military superpower is the economic power behind the military.
No,
The
like soft power matters?
the ability
mean-
to say, I can outspend you, right? I mean, you look at like the Cold War. What won the Cold War? Yeah, it was the US, but really it was democracy and the Western the Western economic engine beat the communist economic engine.
I don't think that's true. I think it was actually the unabashed, blatant corruption on display by the Soviet leaders throughout the 70s and 80s that really soured their populist position with the public and led to the eventual collapse of the Soviet Union. I don't actually think we outcompeted them economically. They had better budgets, way better budgets.
Okay.
It definitely wasn't fucking anything Reagan did. Let's be honest.
Well, sure, we can agree on that. That's for sure. But to tell the world we ran out of missiles against Iran?
Wait, hold on. The people who told the world that are fucking leakers and traitors.
Sure.
Yeah.
But that's bad, because where'd all the fucking money go? You're spending $1 trillion a year and you don't have enough missiles to win a fight in the desert against Iran?
Well, hold on. I mean, give Trump and Pete Hegseth some credit here. They fully destroyed Iran's military, air defense, and navy 7 different times. That's a lot of destruction.
That seems inefficient.
Well, the first time...
Wouldn't you only want to completely destroy something one time?
No, you're missing...
No.
They destroyed it... Well, it was... You don't get it. Hegseth explains this
better
than... He explained it to Congress better than I can. They had more stuff.
Okay.
And so then they blew up all that stuff. And then, shocker, they had more. And it's almost like Iranians have been squirreling away munitions in caves for 50 years. So we think we blew everything up. They heard from the guys on the ground, everything's gone. It's all blown up. And then they had to blow it up again.
So what you're saying
and that took
is
a lot of missiles.
Not only are we out of missiles, but we're also out of intelligence.
Yes.
We can't even determine what is or is not the extent of the military thing that we are bombing.
Now I feel like you're putting a lot of pressure on Bill Plute, and he's only been in office for like 4 weeks. I'm sorry, Pulte, the lost child of the Pulte Homes Group, who was removed from his own family business for being such a fucking moron.
The silver spoon heiress.
Yeah, the director of our national intelligence, Bill Plute, the man who bought bonds from a bankrupt company that sold towels. He also gave money to people who performatively begged him on Twitter.
Oh God, I completely forgot about that. What did he call that?
I don't remember. Like social social panhandling, something like that.
It was something like that. No, it was oh my god. I'm gonna have to look it up. Ron, if you beat me to it, go ahead. But Bill Pulte online giving. What did he call it? It was like social media philanthropy or something like that.
Interesting. And no, I wasn't
Oh,
looking it up.
you're the you're I just because you're on here
Normally, I'm
replacing
able to
Dork this
actually
week.
help, but yeah,
It was
'cause I'm
something philanthropy, like
Twitter philanthropy.
sure, Twitter philanthropy.
I'm
ah,
pretty sure that's what it was. Yeah, he's a full-on rapist. I mean, philanthropist. Yeah, never trust somebody with a neck as thick as their jaw.
Both of which are not that thick. He's a small man. He's
He's a very small man.
yeah, he's not tall. For those of you
Okay.
who aren't aware of this, at one point, Bill Pulte pulled a large group of conspiratorially minded Redditors into an aircraft hangar that he rented in Florida at like $500 a head to tell them that the company that they owned that went bankrupt was totally not going to be bankrupt. And then he gave them bottled water and sent them home.
seems very fiscally responsible.
Yeah.
It sounds like the average like Tesla meet and greet that Elon puts on. Sounds like what he did with the Cybercab unveiling.
Yeah.
It's almost like the grifters are all out of ideas and they're all just copying each other. Anyway, okay. Speaking of grifters, we got to go to the jobs report. Are the grifters running the country and generating all this new credit and all these new loans? Are they creating jobs?
Not according to the last month report.
You mean the last year and a half?
Yeah.
Yeah, the jobs reports are real stinky. They I mean, people have been listening.
No, they weren't.
What?
Well,
Yeah,
for July, it
jobs are
was.
fine. Nah, they're fine. It was like 50, like more than 50% of the headline loss was fucking just like school teachers for the summer. Actually, jobs grew in like 6 sectors. It wasn't bad at all. It was bullshit. The whole report's bullshit. That's why we
Oh,
didn't.
okay.
That's why we didn't rocket to the moon or fall.
Ah,
Yeah. You know what's great though? Labor participation's way the fuck down.
Yeah. Yeah.
So all of the numbers that looked good, like unemployment and stuff, those are probably way worse because we've just reduced the concentration of actual employed people.
Well, I was just
Or
about to say
increased
we've
the
talked.
concentration of actual employed people.
This should be no surprise to our listeners because we've talked about this many times. The people leaving the labor pool equal the people entering, if not, and now are exceeding it, right? So there's
Yeah,
more
it's
people
it's
leaving
more people leaving.
the labor pool than are entering it. A lot of that is definitely skewed to the older people. A lot of that actually tends to be older men.
Mm.
So women as a percentage of the labor force has been growing. But yeah, that's what any good highly leveraged economic system needs, right? That is 70% consumption. They need the number of people that are employed in the country to be declining.
Mm.
That's good, right?
Is it? I mean, it makes productivity look better.
Oh, productivity is going to look great, right?
Yeah.
Until it,
Well, it did actually. It did look better.
yeah.
But that's because people are not working. There's just
Well,
fewer people
also we're
producing less, slightly less.
We're also just marking up fake valuations to our income line as well. That's a
Yeah.
big reason why the
Well, it
productivity
just
numbers are going up.
the labor data actually just distorts everything because you're not really seeing the effect on unemployment because so many people are leaving the labor market, and that's only going to increase over the next 10 to 15 years because b- all the boomers and their children are starting retiring out or leaving and exiting the labor force, and they represent a much larger chunk of the population than the people entering the labor force because they're having fewer and fewer children. um and so like the dynamic there is always going to kind of skew these numbers. And I think until we actually look at like the sum of what is going on inside these numbers, they're largely meaningless. Like unemployment doesn't mean anything if you have labor force participation at like 62%. Who gives a shit what unemployment says? Unemployment's going to look amazing,
Yeah.
right?
Hey,
And
you're
so
not going to
like
get an argument out of me.
yeah, but like in reality, it should be like as an economic indicator much higher. But this also puts the Fed in a weird place unless they revise their models because the Fed relies heavily on the unemployment number. It's one of their central tenets is to follow the unemployment number and doggedly follow the unemployment number. And the unemployment number is structurally lying.
I mean, to be fair, this is Phillips curve bullshit.
It is.
The inflation rate and the unemployment rate have no correlation over long periods over periods of time that are relevant for Fed action. There's no correlation. So they're literally just making shit up anyway based on noise.
Yeah, but it's the Fed's power is not in actually changing rates, right? Because the bond market's just going to price rates where they need to be no matter what. The Fed's power is in the narrative and the hope. It's in their put. And
Mm.
without a Fed put, which we're losing under Warsh, but Basant is really, really trying to create with the Treasury. Without the Fed put, they don't have any power. So without their forward path, right? That the SEP and what the Fed is going to do, the confidence in what the Fed is going to do breaks down. And that's where I think that's where we're going to see the biggest change over the next decade.
Could we start referring to us running out of missiles as the failure of the Pentagon put?
Maybe.
Hmm.
Basant, I don't know. Basant's working his ass off to create a treasury put. He really is. I mean, he bought yen. He's doing
He
it all.
bought yen with euros, two
Yeah,
fake
well, sold
currencies.
euros to buy yen.
It's like if Michael
Euros
Saylor.
are just effectively dollars, though, because of
It's like if Michael
the euro
Saylor
dollar.
sold Fartcoin to buy Bitcoin. It's all made up.
Yeah, yeah, but it's stabilizing. I mean, there's a reason he's trying to stabilize things that he's not telling anybody, and that's that the TGA, even at $1 trillion, is not going to be enough.
Yeah. Well, I mean, the solution is just let rates go higher.
Imagine if the government's solution was spend less money.
Mm.
Remember
Well,
at the start of this
if the rates
administration when
were
they're like,
higher,
we're gonna cut all the spending. But they didn't.
yeah.
They just cut the spending to things they didn't like, and then they increased their spending on, well,
War and war
grift,
crimes.
grift.
Wait a
No,
minute.
just grift.
The swamp monsters that didn't drain the swamp the first time aren't draining the swamp the second time
They're
either.
filling the swamp.
Yeah.
Yeah, structurally
That's what swamp
filling.
monsters do.
Yeah, it's almost like you expect him, you vote him in, and you expect him to do something not swampy.
So here's the thing with like the spending, legislative spending. They might be more motivated to spend less if rates were higher. And
You'd
rates
think.
would be higher if the Federal Reserve would stop fucking monetizing the debt.
Hmm.
So
That's
it's
cute.
almost like the Federal Reserve is not an independent body that's supposed to act as an additional, as an unbiased arm's length check on financial shenanigans, but they are just a way to offload the consequences of bad decisions onto some other entity that
You
is
mean the
quote unquote
U.S.
independent.
taxpayer?
Well, the legislature can do terrible things and then just dump all of the accountability onto an independent body.
Well, it's like, I mean, the Fed is really, I mean, in practice, it's a way to take risk in the banking system and distribute it amongst the taxpayer.
Yeah.
Yeah. Allowing banks to take more risk.
Well, to distribute it among the future taxpayer so that you don't
Sure.
have to feel the effect, to delay the effect.
See, that
Of
worked in 2008, but then they kept doing it, and now the effect is fairly immediate.
Well, yeah, that's the scary part, right? Because yes, they always seem to find one other
Lever to
thing
pull.
right? It's like how many people were expecting Basant? I'm sure there were a few, and I'm sure you're brilliant. But how many people were like, "Oh, well, Basant will take all of the euros that they're holding and sell those to back the yen. That'll buy us another 3 weeks," right? You string enough of those unexpected little pockets of activity together, and you've got 2 more years than you thought. You string enough of those together and you've got a decade, and you string 2 or 3 of those together and you've got where we are right now.
Yeah, but then you run out of string.
Right, but that's the whole game, is when do you run out of string? They keep finding more fucking string.
Mm. I think when the lever is pulled and nothing happens, right? That's when they've broken it.
All right, fair enough. So, okay, we didn't actually really say what the jobs report really said. We're being
I
a
mean,
little tongue in cheek and snarky.
it said labor was down. There was another like 100,000 jobs revised away from the prior two prints. Like, it supported a narrative that labor is weaker, but the losses were really contained in like a couple sectors that were damaged far more than others, and then private job growth is fine. Um, Labor force participation reduction is obviously pushing unemployment down, um, and that doesn't really make labor look weaker. But also, I will point out that wage inflation is kind of moving the other way, and we are seeing wages flatten out. But and that should be supported. Like wage inflation should be up with people leaving the job market. But we're seeing fewer people get paid less, and I guess that's about it. I mean, it's not the cool print bulls needed to confirm the Fed's going to cut, but it was a little bit of that, you
Well,
know.
don't tell financial social media that, because they're pretty much convinced already that the Fed is not going to hike.
I mean, if it were that bad, right, then the market would have rallied way harder on the news, instead of just being up like 60 bips. And then also, like, we're still pricing in like 44% for September, which I still think is wrong. I think we should be far closer to 100. Um, and then as the pricing for that September bet comes back, that's going to hammer equities too, which goes back to our first topic for the night.
All right.
But yeah, I don't
Let's
I don't I don't I don't I don't I don't I don't think this discourages the Fed from moving. Fed might need to
let's
just hike to widen the yen spread at this point. For all we know, Basant's in there telling Warsh, like, you need to fucking hike yesterday.
Yeah, I mean, I feel like the market is kind of doing that for. I mean, they're like you said, bonds are going to do what they're going to do, right?
Yeah.
And we talked earlier about how banks are struggling to keep enough cash reserves with all of the investments that they're making. Well, the greatest way to maintain your cash reserves when you're doing a lot of investments is to get a return on those investments.
That's awkward.
Yeah. And a great way to get a return on a, fixed investment like a bond is to demand a higher rate. And
Did you
so if the reason that your cash is going down is because you're buying so many bonds and you need your cash to stop going down, then maybe your bond rate should go up.
Oh, you mean like you would demand more money for more duration?
Yeah.
So crazy.
And that's what bonds are trying to do. And it's what the Fed and the Treasury and everybody else keeps trying to avoid.
Stop. Yeah. Well,
But
that's because, for example, Japanese insurers just reported like a 90 billion in paper losses for the last quarter.
yeah, it's child's play.
Yeah, it is. But I mean, they're smaller. But I mean, if US yields, if the 10-year goes up to like 5.5%, you're gonna have US GSIB sitting on hundreds of billions of dollars of losses, trillions of dollars of losses.
Yeah, but the Fed will do whatever it takes so that they'll have the liquidity, right? They don't effectively what the job of the Fed is to convince everybody that there is no such thing as duration risk.
Yeah.
So anyway, we'll see how that unfolds.
We still get a 2008 out of that at a minimum.
Sure, maybe. Okay. Well, okay, so let's do a pivot to talk about earnings this week. Let's keep this moving along.
Yeah.
So, are there any earnings this week that catch your fancy? I mean, I of course am gravitating towards the AI names. You got Supermicro, CoreWeave. Those are on Tuesday afternoon.
I only care about Kava, fine purveyor of fast Mediterranean food poisoning.
Yeah, I've been to Kava maybe 6 times, and the first 3 times I was like, "Hey, this is pretty good. I like it." And then the next 2 times just like, "Okay, this is okay." And then the last time was just like, "Okay." And then I just never thought, "Hey, I want to go to Kava
It's
ever
like
again."
Chipotle without a tortilla.
Yeah.
Yeah.
Food quality is a bit better.
I prefer Naf to Kava personally.
I don't even know what that is.
I don't know. Cisco probably matters.
Yeah.
Supermicro. B&G? Is that the company that makes pickles?
Where? What day is that?
B&G Foods? I think they make pickles. It's after close on Tuesday. Companies that don't matter. I'm going to disappoint a whole bunch of Reddit here. Hims and Hers and AST Space Mobile. These companies are irrelevant. We already know that SpaceX had terrible earnings, and they're the biggest one.
Yeah.
Who's Firefly?
We've also got Cerberus on Wednesday, which kind of interesting, at least for like hardware. Although they're so specialized that it's hard to like extrapolate that to any sort of general vibe. Applied Materials Thursday afternoon. So they do.
What's Applied? AMAT. AMAT is on Thursday. That's a big deal.
Yeah, they do.
That's a very big deal.
Semiconductor fab stuff.
Yeah, find out how many more fabs they sold to China.
Yeah. Yeah, so a couple of those, but yeah, we're kind of getting into the back end of earnings. Monday. So we're going to start seeing sort of, I think, a shift to other narratives as we wrap up. I mean, at this point, people are just sort of looking at the statistics of the quarter instead of the individual names. I don't really see anybody on here that could potentially upend the larger trends and narratives that are ongoing. I mean, CoreWeave could be one, but they'd have to really flop because, I mean, as much as they are a bellwether of AI compute and neo cloud health, they're so small still. And with NVIDIA doing, vendor financing and just straight up investing, giving them money to buy their chips, I don't see how they could screw up that badly. But we'll see.
I'm not interested in too much. I mean, this is still a big chunk of the S&P reporting this week, but it's definitely smaller. Plug? No. Oh.
Yeah, I think
yeah.
that's it. Yeah, I'm gonna
Yeah,
call
it
that.
really looks like Supermicro, Berkshire, Supermicro, Cisco, and Amat are the big ones.
Yep, agree.
But that's enough big ones. It's almost one a day. It's it could be fun.
Yeah, it's your average expectation from him and hers, one a day.
I like what you did there, but I also hate it.
Yeah. All right. Anything to add on the calendar from last week? We already talked about a lot of this, but is there anything from last week's calendar that we missed that's worth talking about?
No, I think we covered pretty much everything from last week.
Yeah.
I mean,
Balance of
import
trade
prices
was
are still
poopy.
scary looking. ISM services prices were way the fuck up. Also, ISM manufacturing and ISM services jobs looked way better than what we saw in NFP.
Interesting.
Which was interesting. Yeah. Japanese household spending's falling through the floor.
Oh, good.
Yeah.
That's probably nothing.
Deal.
Okay. So, calendar this week. Do we have anything of note?
CPI.
CPI.
Yeah.
On
Existing home
Wednesday.
sales is a big deal. Those are expected to fall. How much they fall can be a very big deal, right?
Then we get
Remember, don't forget the MBS market. All of these banks are sitting on big piles of MBS that are tied to the equity valuations of all these homes. And if home equity values are declining, then the MBS values decline, and then the leverage ratios get fucked up, and then everything goes boom. Houses have to always go up. Houses going down is about the most bearish thing our economy can endure, and they're currently dropping.
You don't want to hear about all of the price drops in my area then in Texas.
Oh, no, I would love to hear about them. Please.
I get there. People are becoming more it seems like fewer people are just doing the pull it off the market and wait and just keeping it on the market and dropping the price.
That's because they did the pull it off the market and wait 6 months ago. Now they're putting it on the market
Right.
because they actually have to sell it.
Well,
it's
6 months a year, 6 to 18 months ago. Yeah.
I have a question to ask all the home flippers out there, and you guys can, if you're watching this on YouTube or whatever, leave a comment and answer. Did you think when you bought your home that it was going to be worth 100% more in 3 years?
Buy the home, date the rate. Buy the home, date the rate. Buy the home, date the rate.
What's that asshole's name?
Which one?
Well, nobody wants to date the rate when the rate is 6.69%. That's an ugly rate. Like, no one wants to go out with them.
Yeah, but on the other hand, it's 6.9.
Do you really want to get 69 for 300% of the total cost of the home? The total cost of finance of $400,000
if I'm paying
house at
300%,
7% interest. Yeah.
If I'm paying 300%, I hope to get something out of it.
We also have PPI and retail sales. What do you think those are going to look like?
Yeah, I'm almost more interested in PPI than CPI just because of how much oil goes into it and how that tends to transmit first to PPI.
Yeah, it does.
So I'm pretty interested in that. Retail sales, I don't know. I mean, again, you're taking kind of an average measure, but it's so skewed to the top end, which as long as stocks are up, I think retail sales are going to be, at least they're not going to bottom out.
But they weren't up last month. They were down most of the month.
Oh.
Yeah.
Oh, X autos were down, yeah.
Mm.
I don't know. I
Michigan
have no
consumer
expectation
sentiment
there.
will be interesting too.
See what those Michiganders are thinking. Someone needs to tell them that
Well, I think it's the
100 is
preliminary,
average.
so it'll be the most impactful of the reports.
Yeah, and there's, I guess in Japan on next Sunday, we get the GDP growth rate. Might be interesting.
Just through the roof from inflation.
So I think that's it on the calendar. So Ron, do you wanna play a commercial and we'll get back into the back end?
Why so long, producer Ron?
I'm only playing Leaps because I learned my lesson on zero DTEs. But all my money is tied up on a handful of trades.
Why not use GammaStrike?
That's too complicated. It's accurate, but I'm not a genius. I can't figure that out.
Nah, you'll learn it. They've got a great docs page, and there's a roundtable videos section that will break it all down for you.
No kidding. I'll have to check it out and maybe stop going so long on everything. Thanks, Dork.
Don't thank me. Thank Team GammaStrike.
And welcome back. So as Dork is out today, we'll be going right to Dork's backside, and I'll be filling in to kind of help with that. So first
Ron,
off,
you're going to be filling in Dork's back end?
Yeah, I don't like this. I don't like to say it that way, but it's not wrong either.
Well,
Actually,
you don't
I
really
think-
have to say anything.
Yeah. What were you going to say?
Nothing. No.
Okay. All right.
I'm gonna leave this one alone. Sometimes cooler heads prevail.
Yeah. So just as a reminder to everybody, if you do have questions, every week we do try to reach out on our socials. So feel free to reach out there. We're also on Discord, Reddit, X, and Blue Sky, and YouTube as well. So if you have questions, feel free to post them. I did want to kind of put out a quick note that we are really getting a lot of questions lately. So we're going to try to do our best to answer them. But to be honest with you, we might have to start getting to the point where we're not even going to be able to get everything. So if we missed your question, please feel free to repost it. We'll try to get it incorporated. This week, like last week, we had a ton. I was trying to actually just queue them up, but I think we got so many this week that we may have to go back to the next week. Next week, we'll have to go back to some of the questions that we missed from last week. So better just to repeat it if you still have it open. So, all right, with that, we'll get started. So here's the first question, guys. On Discord, this question comes from Arizona State University recently launched a new major in content creation where students spend 4 years and tens of thousands of dollars learning to monetize attention. Beyond the cultural irony, isn't this a perfect symptom of a financial economy that no longer produces real goods, just rent-seeking, attention arbitrage, and hype? What is the structural root cause of this grift economy? And what economic pivot would it actually take for the U.S. to build tangible things of value again?
Can I start as the professor here who works at a university?
Course.
Okay. So I would say, first of all, that I don't know that this is necessarily a symptom of, economic decay necessarily, right? Because you might ask, what's the difference between a degree in content creation or a degree in theater, right? I mean, isn't theater also a form of attention arbitrage, hype, right? You're creating content for somebody to consume. I think there will always be a place for that. There's obviously a lot of demand for that. Um, and I don't want to put words in this person's mouth, but I think the thing that is so off-putting about this in particular is that it feels like grift in a way that maybe a theater degree doesn't, right? So it's like people kind of know, like, hey, everybody thinks there's a chance that I'm going to go into theater and make it big. But I think most people kind of know that, like, the ROI is probably not super great on that. And I think, this one, content creation, it kind of feels predatory from an institution perspective. They're like, everybody is desperate and wants to make it big. They see all of this content being created on YouTube. They spend a lot of time consuming that content as young people who are predominantly, my own kids. They consume a lot of content created on YouTube from content creators. They're just not consuming content the way that I did when I was a kid. And so, of course, people are going to want to do that. Like, everybody wants to be the next Mr. Beast. And the question is how are they selling this degree? Are they selling it as a way for you to become the next Mr. Beast? Or are they selling you like the reality of the situation? I don't know the answer to that. I suspect it's probably a little bit more towards like the Mr. Beast. But I mean, you look like 7 to 10 years ago, I remember hearing there was kind of like a little bit of a buzz around professional gaming degrees. You could go to college to learn how to be a professional gamer. Is that any worse than this? It may be. But those kind of things will always exist. And this was, I think the professional gaming thing I saw was like University of Indiana or something like that. So kind of a similar deal to Arizona State. Um, I would, yeah, I would say universities are in a weird situation where they're trying to make a lot of different people. They're trying to literally make every interest group happy. They want to make the government happy. They want to make their students happy. They want to make their professors happy. And because they're in that situation where they're always being pulled, and they also want to make the general society happy, right? And so because they're always being pulled by literally everybody in a different direction, it's unlikely that they're going to be the source of any of these issues. They might amplify some of it or not prevent enough of it, but I don't know. I don't know. I don't know that this is actually a symptom of the grift economy. I don't disagree. I think we are in a grift economy. But I don't think that this is necessarily an indicator of it. Now, the second part of your question, which is what would it take for the U.S. to actually build tangible things of value again? I think the U.S. So the U.S. does still build things of value, and they tend to be cut more on the cutting edge, right? The kind of stuff you're getting out of, Southeast Asia and some of these other places are more like the commoditized things, right? If I need a really well-made generic part, I can order it from China and get it here in a week or two, and it's half the price of what I can get in the US. But if I need a really high quality part and it has, trade secrets and things that I want to protect, I'm gonna look in the US, and there are places in the US to get that stuff. So I think
It was like the ball bearing thing all over again.
I think I think we want the US to be building bespoke high valued things, and that's happening. But you just need to give people the buying power to want that stuff, right? I mean, like nobody wants to buy their shit from Temu, but they also don't want to spend a ton of money on a shirt, right? It's like, why would I spend $100 on a shirt when I could spend $7 on a shirt and throw it away and get another one later, right? And so everyone's just like, it's as your buying power goes down, your standards go down with them, right? And so so you want to make things of value again. You need to pay people more. I mean, the consumer, the personal wage earners, they're earning less as a percentage of the economy than they have since 1929. So you want America to make things that are valuable again. Give them, share the value with the people that are buying the things. Anyway.
Yeah, I feel like it's more of a sociological problem. I mean, first of all, not to really shit on everybody who goes to ASU, but it would be hard to sell this to a different audience. I mean, like 120 credit bachelor's degree in content creation is probably the most perfect monument to the direction of our economy. But by promising like students that they can monetize something on a platform that they don't own or have any control over, but like it's not like it's not like the video production or journalism or advertising or digital marketing are completely useless. Like those are real skills. I think it's just the absurdity in credentializing that into a product, which may be more of what our economy is about, is the fact that a university is selling this to students. Not that students are actually signing up to do it. And I think like to fix that problem, where the goal of a career is to make money on a platform where you have no control, is probably like, I mean, we already still manufacture enormous quantities of real goods. It's the reward for that. I mean, if you can make it as an influencer, then you can make millions and millions of dollars, which may be more than you would make in an entire career in another industry. And those degrees have kind of the same reward structure, right? You get a degree in business and you go work at a bank and you make $80,000, and you make $100,000, and you make $120,000, and then maybe over the next 10 years you bump up to 130, and then you're out. And maybe one person in that class goes and has a different trajectory, and they end up an executive, and they end up, the CEO of a bank. And the odds are not in the totality of students' favor to reach that potential, but the degree is still sold to them regardless. And so it seems like this isn't that much different in some ways. I mean, like getting trained to go work at a corporation where your returns may not reflect the returns of one of your classmates is similar, except in this instance the returns would be zero. um but I think we need to reward, like ownership and intermediation and extraction more generously than we do production, and create an economy where where there is incentive again to make things and create things and build things, and I don't think that's something that we're doing. We have a publicly traded economy, and I think that's the real issue, is that everything is done in service to the shareholders, but nothing is done in service to the workers or the people who create and build. And in that economy, what's the difference? If you're gonna make jack shit being a plumber, or getting a certification in HVAC, or being a banker, why not make jack shit trying to be an influencer? If you're successful in any of those fields, you'll make a lot of money. You'll be very successful by our society's measure. But this is no different than that. And so until we incentivize those things, we're going to continue to slip into all this grift, and avoid tangibly changing anything. Everything just exists in a digital space.
All right. Very good.
I just want to add really quickly.
Sure.
You can look up the ROI of any university in any degree and get a decent sense of what is the return on investment of this particular program. I would encourage you to do that. If for something new like this, I would always approach it, with a grain of salt. Because like I said, is this actually unique? I don't know. I'm looking online at Arizona State University ROIs. A master's in communication and media studies has an ROI of negative $150,000 over your lifetime, right? So there are negative ROI programs that are already everywhere, and demand that, especially from a going concern like Arizona State or any other university that's been around for a while, demand numbers. Show me that what you are providing is of value. And yeah, so there's that. All right.
All right. Next question is from Discord, and it's a perennial one. When?
A Monday
September.
after OPEX, probably
Yeah.
September.
All right. Next one's from Discord. Microsoft earnings showed that OpenAI accounted for roughly 70% of their AI revenue. Furthermore, it is being estimated that OpenAI and Anthropic make up over 70% of all AI revenues across Microsoft, Google, and Amazon. How are investors not running for the hills at the prospect of this unprofitable money furnace? And largely depends on two companies somehow turning silicon into gold.
I'm very confused as to why they chose to put the elemental symbols for silicon and gold in there.
Just to show off their knowledge of table of elements.
Interesting.
If they are in the semiconductor world, they've seen SI and AU so often that they probably just think that way.
Maybe.
And maybe they wrote silicon and gold next to that to make sure that we knew what they were talking about. Because we'd be like, hey, you, what's that? Yes. Yeah, great question.
Because they can't get the fuck out of their Anthropic and Chat GPT or OpenAI equity. So they've got to keep holding the public companies that own them.
Yeah, I wrote about this on the Twatters. If you want to go look it up, I wrote about exactly this question, where we have now officially surpassed. We have created 20 gigawatts of AI compute, and of the 1 billion knowledge workers in the world, the brains of those people is about 20 gigawatts. So we are now at power parity with the entire knowledge worker base, and we have just about nothing to show for it except a lot of spending. it's the likelihood that it's going to turn out okay is, to me, it is basically zero. But I think what most people are looking at is OpenAI, as an example, makes about was it $10 a gigawatt per year, something like that. Their ARR has been about $10 a gigawatt since they started, hasn't gone up or down. And so the assumption then is if they go from 2 gigawatts, which is how much power they're currently, or the last time they published numbers were consuming, if they go to 20, then they should be making $200 billion. And if they go to 200 gigawatts, then they should be making $2 trillion. So it's just, we're extrapolating a straight line and hoping that it continues. And the problem is that they're not making any money. They're selling everything. They're selling $5 of compute for $1 essentially, and the world has descended on that arbitrage in size, and yet they refuse to close it and charge more money because they know if they charge more money, the growth dies and the story dies and the whole thing collapses. So, but anyway, I wrote about all that. You can read it. So until somebody flinches, they're not, everybody's waiting for somebody else to blink and nobody's blinking. And now these companies are no longer profitable because of how much money they're burning. And everyone's just like, why the fuck is nobody blinking? I'm sure Sundar Pichai is just wringing his hands every day. It's like, why is that fucker Satya still buying data centers? And what the fuck is Zuckerberg doing? He's not even involved in this arms race, but somehow he's inserted himself right in the middle of it. Like, hey guys, I'm buying them too. I'm fighting the war
Zuckerberg
too.
just likes to show up to things and be like, I can also spend money.
Yeah. And so everyone's just like, why the fuck won't somebody stop spending money? I want to win. So anyway, yeah.
Is the person who stopped spending money first the first winner?
No, well, at this point, everybody's going to be a loser. The question is who survives?
I wonder if Google, I want to kind of actually sit down and try to see if we can model, like, fuck it, Microsoft. If Microsoft never makes a single dollar off of AI, what will their earnings reports look like in 3 years?
For the next decade? Yeah.
Yeah.
Wow. All right. Next
I've thought about this a lot. Yeah.
Yeah, I have too.
Actually, before we go to the next question, JFresh, could you plug your Twitter account on socials?
Dr. Gingerballs with an underscore between Doctor and Gingerballs.
Is that balls with an S or a Z?
S. I'm not. It's a serious account. It's not a joke.
I know.
And do not ask me.
I've seen your balls.
Do not ask me if the curtains match the drapes.
They do.
Yeah. Next question on YouTube comes to us from YouTube. Are we nearing the straw breaking the camel's back phase for SPX, or are we going to 8,500 soonly?
Hold on. The beauty of JFresh knowing that his daughter's going to listen to this is not lost on me.
They know I'm Dr. Gingerballs.
All right.
They made an account on our Disney shared plan, and I'm Dr. Gingerballs, and I'm some weird animal they found. Anyway. So camel's back or 8,500 soonly.
We already talked about this. Is the whole
we talked
intro to
about
the
this
show.
at length. Yeah. We talked about this at length. Go listen to the show.
We can
All right,
skip the Trump Iran one too.
Yep.
Obviously, if
one.
he withdraws, Iran's gonna use their leverage on the global oil market to do whatever the fuck they want.
Yeah.
Next one's from Discord. Now that SpaceX has a bunch of new shares that can be sold, what's everyone's thoughts on where is it going? I know we talked a little bit about this earlier. Are we seeing a short squeeze from an unexpected bounce, or can Elon's magic help prop up SpaceX just like it does Tesla?
All
it
of the
doesn't prop
above.
up Tesla that much.
I mean, if you're gonna try to short that fucking bag of shit, you got to be ready to get your face melted off.
Yeah. No one's going to sell under the IPO price. I'll say that much.
All right. Next
One
one's
doesn't
from
simply short Elon Musk straight down.
no.
No,
It's a
no.
good way to lose money. All right. Next one's from Discord. Q2 GDP slowed. Payroll growth has now turned negative, while headline CPI is still 3.5%. At what point does the media stop calling this late cycle slowing and start calling it stagflationary regime?
When they start losing money after a stock market crash, stock market crash,
Stock market.
stonk, yeah.
Stock crash.
Yeah.
Yeah. I want to. I probably. I mean, I think as soon as a major media outlet calls Donald Trump a pedophile, we'll probably also see them say the word stagflation.
That
But it's
also will
after-
only happen
after.
after a
Yeah,
market
after
crash.
they lose money. Yeah.
Yeah.
This is correct. Yeah.
All right. Next one from Discord. I know we touched a little on this earlier, but there's a second part that I like. The personal savings rate is only 2.7%. If employment is now weakening, how much cushion does the consumer realistically have before consumption rolls over?
I mean,
No,
not much. Have you
zero.
looked at the
Yeah.
HELOC growth?
Yeah, HELOCs are growing almost. They're growing faster than mortgages. Yeah.
Yeah.
Um,
Everyone's trying
Yeah,
to
no,
remodel their house and sell it for 100% more in a market
This is
that's
what
saturated.
this is what inflation does, right? It causes everybody to chase, and it causes exactly what we're seeing, right? Lower savings rates.
All right, next one. How much AI data center capex masking weakness how much is AI data center capex masking weakness underneath headline investment? If you stripped hyperscaler and AI infrastructure spending out of the GDP and earnings expectations, how different would the underlying economy look?
I mean, the
That's
H8 stuff we talked
completely-
about earlier kind of laid out a lot of it, at least half.
Yeah. Almost more.
Probably more.
I mean, yeah, AI, hyperscaler and AI infrastructure spending is basically all our economy's been doing for the last 6-8 months.
Yep.
Like there's almost nothing. I mean, we have
And then
tariffs
before
and
that,
higher oil price, everything else is
before
shit.
that, since 2024, all it's been doing is creating more nurses to wipe the asses of all the old people retiring with their stonk money.
Yeah, but not AI nurses.
Not yet.
Yeah. All right. Next question. This one comes to us from Discord. When you see a large increase in put positioning at a strike, what combination of IV, delta, volume, and subsequent dealer exposure gives you the highest confidence that those puts were sold rather than bought?
This is easy. IV goes down.
Perfect. All right. Next one's also from
Anything to
Discord.
add, Gherk? I think that's.
I mean, you can if you're using GammaStrike, you can use the PCR tool, like the call premiums. So you can look if premiums are falling and put volumes going up, that's probably puts being sold. So that could be like an additional indication. But otherwise, yeah, IV down.
Cool. Next one's also from Discord. Do you think zero DTE has made the market more stable most of the time, but more unstable at the tails, especially suppressing realized volatility until positioning flips and then accelerates the move?
That's exactly what it does.
Yeah.
Yeah.
That's its function. That's
You're just
why.
you increase risk at the tails, decrease risk at spot.
Yeah. People need to realize the customers of the CBOE are the market makers, not you. The market makers love this shit because it helps them hedge their book in the intraday. Because everybody, insurance companies are huge put buyers and other places. They buy tons of longer dated puts. And so the market makers are short a bunch of puts. But then 0DT comes in, and every day people sell an ungodly number of puts and calls into the intraday, and essentially balance their book for them. And so it is definitely a stabilizing effect that market makers love. And then the market makers also just get to enjoy tons of volume that they get to play the spread on. And so, yeah, they
I
absolutely
think
love
the
it.
exchanges love the volume.
Yeah, fair. Both, right? But I think there was a great example of it was August 2024, 2025, I can't remember, where VIX in the morning went to like 65 or something like that.
Yep.
And then like 15 minutes into the trading day, it was back in like the 30s or even the high 20s. I can't remember what it was. But the VIX was so high, not because people were buying options, but because nobody was trading options and nobody was
Spreads
selling
blew out.
options. And so, yeah, the spreads blew out, and basically the market failed to make. And so because the spread blew out, VIX went up, right? I mean, your price is the average between, buy and sell. And yeah, so VIX just spiked because prices diverged. And so then once 0DTEs were able to be traded in size during markets, it all got back under control. So yeah, 0DTEs are very stabilizing.
All right. Next question comes to us from Reddit. What signals should one look for in index markets, reserve banks, government actions, etc., that would be a sign of when is about to happen?
Ooh, well, here's a good one. Like when a foreign power reaches out to stabilize the currency of a different country.
Yeah.
For those of you that are listening to us on audio, there's definitely some visual cues that Gherk gave to us with his eyes and facial expression there. So anyway,
Thanks, Ron. I
had to
feel
help.
like my silence was enough for the audio listener.
It was, but
That's a big one. Obviously, you look for funding stress, illiquidity in bond markets, spreads widening in corporate bonds. You can look for over suppressed volatility, like we see with the current 1 and 3 month correlations between equity vol and index vol. You can look at the 3 month correlation versus bond vol. Like obviously FX market spreads can make a big difference in all of that. I would say if you see governments repeatedly taking policy action to stem risk, that is the first indication that everything's gonna fucking blow up. Um, there's other stuff. I mean, there's like the stuff we see in private credit right now that's trickling in that just keeps looking worse and worse. You know, um, there's the tightness we have at like the front end of the curve in short-term funding. That's not good. You have losses and reserves from major GSIBs where they're over lending against their reserves and depository guarantees are looking a little slim. And then you have the upside risk and yields for those banks where if yields move up, the leverage they have in the market right now, especially in the technology sector, becomes a major risk for them, and they have to risk off because they have to reduce total leverage because they don't have enough money. And so all of those can be signals of when. I would say those are more immediate signals that I would be looking for. Leverage leaving the markets is another good sign. But yeah, I would say right now, one of the really big ones would be recent reductions in reserve requirements for GSIBs. That's a big sign. Obviously, there's stress, or they wouldn't need the requirements reduced. Failure to comply with Basel III is a pretty big one. The Treasury intervening in the yen market, also a huge one. That's a really huge one. That's like a big red flag, especially because that intervention has ultimately failed. Leverage is returning back into short yen. And a lot of it was pulled back, but speculative leverage pulled back. So big CFTC positioning shifts in their weekly report is also like a big signal. So I think the last CFTC weekly report, hedge funds pulled back 50% of their yen shorts, which tells you something's up, because those are speculative bets. They're not hedged. Like, hedge funds aren't participating in the basis trades on a large scale. So they're speculating against the yen, and now they're saying, I don't want to be short the yen, which is important, especially given the yen didn't move all that much. There's a lot of upside room to it if things were to start pushing out, and the basis trades were to start closing. So yeah, I don't know. Those are some of the things I look for.
I've got one that I forget if it's actually even being used anymore, but I remember people were doing a little bit where unexpected late night deliveries to the banks. I'm not sure if you guys have heard of that one or remember that one.
They're just open like this. Remember the whole bullshit with Citadel having its lights on at night?
Oh yeah, that
It kind of
completely
just
didn't
reminds
work.
me of that. Like these fucking places are open 24/7. There's people who literally work in foreign markets and overnight, at every major bank. So I mean, I guess maybe increased deliveries,
Yeah.
but I don't know how you track it.
Well, yeah, you'd especially have to work out month end, quarter end activities and how to what's normal there versus what's abnormal and how abnormal is it really.
Yeah,
But a lot of late night meetings that are unexpected could possibly signal something.
I think maybe a better signal is if people start falling out the windows of hedge funds.
Oh,
That's
yeah.
usually a good sign that win is upon us.
All right. We've got two last questions. These are actually a little lighter. So the next one's from YouTube. Can the quants do a round of muted fast money for us?
Wait, did we skip one?
No.
Oh, yeah, you're right. We did skip one.
Oh, we did.
Well, we'll do this one first,
This
and
is the
then
one that I wanted to answer.
we'll do this one first, and then we'll go back to yours that you want to answer.
All
Then
right.
Well, I'll go ahead and say I'm not really sure what you're talking about. I had to look up what fast money was. It's like a CNBC money or a market on close. I guess they get like a round table together and they just discuss shit. I don't know what
That's what
muted
that's
means. Do we mute them and pretend to say what they're saying and make fun of them?
I think it might be because I keep forgetting to turn my microphone on when recording Market on Close. I've stopped doing that, but I've done it on a couple of occasions. Like, I recorded one episode that was entirely silent.
Oh, that sucks. Did you have to do it again? Did you actually record it again?
Just did my
Oof.
whole night. It was terrible.
That's the worst. You need a producer.
I know.
don't look here. I'm not that good. All right. Now we'll get to your questions here. So this one's from Reddit. Is there a scenario where we could crash but end up with hyperinflation? And if so, could you explain the mechanics behind it?
Yeah, so it doesn't
we we crash and then the feds buy all the shit and print a bunch of money and then everything just goes straight up and the dollar becomes worthless.
Yeah, well, that's one way. So yeah, I mean, the path isn't usually that direct. Like, you get deflation first, then you get fiscal monetary failure. So it's like you get a private sector crash, then the sovereigns absorb the losses, then fiscal credibility deteriorates, then central banks monetize the deficits, then currency demand collapses, and then you get hyperinflation. So it's a
So we
little
need
bit.
another cycle because we did
No,
2008 was the first cycle.
I don't think we need
2020 was the
another one.
second cycle.
I think we're already nearing the end of this one. I think we're already at like the currency demand collapses part. Right. So like the initial crash is normally deflationary, asset prices fall, collateral value collapses, credit creation shrinks, and then banks tighten lending, unemployment goes up, money velocity falls off a cliff. And so at that point, cash and government bonds usually rally because investors are deleveraging to try to find liquidity. And then so the problem really begins when the losses, like when governments start to socialize all those losses. So bank guarantees, bailouts, unemployment benefits, defense spending, energy subsidies, collapsing tax receipts, um, uh, and like the higher interests start to push deficits sharply higher. This sounds familiar. And like private sector balance sheet risk becomes, through this process, becomes sovereign balance sheet risk. So, and then if treasury issuance grows faster than the private sector can absorb it, already happening, long end yields will begin rising despite the weakness in growth. Huh. Is this sounding familiar yet, guys? And that's probably the point at which you've hit critical mass. Higher yields are going to raise government interest expense, which then increases deficits, which then requires more issuance. So you get, higher yields, higher debt service, larger deficits, more issuance, still higher yields. And that starts to loop. And eventually the central bank has to face the choice of allowing sovereign yields to clear at levels that can destroy banks and insurers and pensions and housing and government finances, or they try to suppress yields through QE or YCC. And so the central bank then becomes, as everyone knows, the structural buyer of like last resort. And monetary policy crosses over into fiscal dominance. And the central bank is no longer expending its balance sheet because financial conditions require easing. So it creates base money because the sovereign can't fund itself at market rates. And so that at that point, the adjustment migrates from the bond market into the currency. And if inflation is 10%, but the central bank caps the 10-year yield at 5%, investors are going to have to are going to be forced to accept like deeply negative real yields. And then immediately domestic and foreign holders both reduce exposure. FX weakens, import prices skyrocket, inflation accelerates, and the central bank has to buy even more debt to prevent yields from rising further. And so you end up with like fiscal deficit into monetization, creates currency depreciation, imported inflation, higher normal spending and interest costs, larger deficits, which then leads to more monetization. And then the hyperinflation itself requires one last little step, which is just a collapse in money demand. So printing alone is not sufficient. The public has to stop wanting to hold the currency. And once households and businesses believe that cash will lose repurchasing power, they will shorten the duration of their holdings of real currency. And so you get like, paycheck immediately goes to goods. Corporate cash will start immediately going into inventory. Domestic savings will immediately go into real assets or foreign currencies that are more stable. And foreign holders will just sell all their local currency assets. And then, velocity rises sharply because all of these transactions are occurring. And now the same base supports much more nominal spending, while currency depreciation raises the local price of everything. So currency down, prices up, money demand down, volatility or velocity up, and then currency down further. And that generally coexists with a real depression because nominal prices and real values are no longer at parity. Good. So like SPX from 7,000 to 3,000, then to 30,000.
Yeah. No notes.
Okay.
All right. Very good. And here's our last one. Though the boys are not allowed to proffer us financial advice, could they offer us love advice?
Sure. But I mean,
You
I
want
can't
good
just,
advice? I could.
yeah, throw us your best question that
Yeah.
you've got. And I'll answer it.
All right. Somehow we managed to get through all the questions. So it's time for everyone's favorite segment, which is
Stupid bets, stupid bets. Who's gonna win? Who's gonna lose?
Oh, Dork is here.
no, he's just for that. But good try. All right.
We could
So
have tricked
last
the
week-
audio listeners.
Yeah, they might have been confused for half a second. All right. So last week, you guys remember what the question was, right?
Yes.
If not,
Yeah.
you got it printed right there for you. So the question was, what is SpaceX's predicted free cash outflow using Price is
FCO.
Right rules? Yes.
FCO.
I love that
gonna
I've
be out there.
turned that coin. I hope I get in a financial textbook at some point.
That would be pretty cool. All right. So starting off at the lowest end, we had Dork with 2.81 billion. Gherk was at 3.44 billion. And JFresh went with around 10 billion. And what we ended up finding is that JFresh ended up winning with SpaceX.
And I was still ridiculously low.
Yeah.
You were. You weren't even close. I thought they would have tried to rein in spending when they were going to report publicly. Not at all.
No.
Nope. So
that
they ended up
25
spending.
billion that Elon borrowed, he really needed because he was going to spend it immediately.
Yeah. So they ended up spending 18.4 billion just in Q2 alone, making their first half negative FCF toward 25 billion. So what are you
Negative
guys
FCF.
thinking?
That's FC. That's positive FCO. It's positive.
Yeah.
Positive 25 billion FCO.
It's one way to spend it.
All right. So what are we going to do this week? I have no idea. Let's do, well, Ron, this could be your opportunity to slip your own bet in there.
I don't know that I'm going to have anything good, to be honest with you guys. But maybe we can come up with something better. Let's see. What are you guys thinking? Should we do something? Could always do earnings, something interesting that's going to happen this week that may be outside of traditional finance.
I bet oil goes up.
Maybe, wait, here's maybe a better question. Is oil going to be up before market open tomorrow morning? Or is it going to be back down? That was something I was talking with JFresh between the break on.
Wait, what's it doing in the overnight?
So I think as of a few
It's
minutes ago,
up,
it's still
but it's
up.
up barely.
Yeah. So does it
Yeah.
still end
Up-ish.
up by 9:30?
Ooh, we're gonna bet on market open.
Yep.
Doesn't the video version of this come out on Like
Usually Mondays.
Tuesday? Oh, Monday.
Yeah,
Yeah.
we've got to let's let this one breathe though. We don't need to
Yeah, I
do
want to
mark it
say
open. Let's
oil
do
87 by end of week.
Ooh. And it's what now? What's the current price?
Yeah, I was just about
78.
to ask.
78.83, up 83 bips overnight.
So we want to do Prices Right rules for what we think it's going to close at next week?
Yeah, let's take a look Greeno here. Little looky-loo, as they used to
Yeah, I want
say.
87 or higher by end of week. That's what I want to call.
Okay.
I'm not going to put any
By
real
end
money
of
on that because I would
week?
never buy oil unless it broke 81. But I might put real money on it if it starts to go that way.
You say 87 by the end of the week?
Yeah.
Yeah, I'm going to take the under on that.
You want to?
How far under?
Let's
I
make
was
it
thinking
real nice. Let's do a gap. Let's
84.
say it'll be under 81.
Oh, ooh.
Whoa.
I would. The only other option that I would have even remotely considered would have been like 84.67.
Not 84.69.
No.
I'm thinking 8308.
Okay. I didn't
Yeah.
realize that we all were bringing our second decimal place to this gunfight.
You can modify it still. You have a few more minutes.
I will modify my bet from $81 to $81.00.
Oh shit!
Oh. I'm surprised at least one of us hasn't gone like 1 cent just to make sure they're fully getting the Prices Right rule benefit.
I've got every price above 80. That's infinite. I have infinite prices on my scale. This is the best bet ever.
Yeah. All right.
You guys are
So-
all limited. You have limited ranges.
You're about to learn about dispersion of outcomes, friend. Density of states. Probability distribution functions.
You would know more about density of states than me. You live in a fairly dense state.
Whoa.
Is that where you mean like geographically or mentally?
They're both insulting. You pick one.
Come and take it. No, Texas is a terrible place. Don't come here. We don't want you. I mean, you don't want to be here.
You don't want us. Don't come be trapped in here with us.
All right.
I think that's an
That's our
episode.
bet. That's the whole episode. All right. Have a
That's
good
an
night.
episode.
Thanks.
All right.